The stock market is not what you think it is, a complete beginner's guide to how markets actually work. Welcome back to SERA Finance. Smart Money. Real Talk. Season 2 starts right now. If you have been with us since episode 1, welcome back. If this is your first episode, you picked a genuinely good one to start with. Because today we are doing something I have wanted to do since the very first episode of this channel. We are going all the way back to the beginning and building the complete picture of what the stock market actually is, how it actually works, and why almost everything the average person believes about it is either incomplete, misleading, or just flat wrong. I have talked to enough people about investing to know that there is an enormous gap between how most people think about the stock market and how it actually functions at the level that produces real financial understanding. Most people think of the stock market as a place where prices go up and down for reasons that are too complicated to understand, where professionals and algorithms have all the advantages, and where ordinary people participate at their own risk with a vague hope that the long-term trend is upward. That picture is not entirely wrong. But it is missing so much that it actively prevents people from making good financial decisions. It creates anxiety where clarity is possible. It creates passivity where informed participation is accessible. And it creates a sense that the market is something that happens to you rather than something you can engage with deliberately and intelligently. Today we fix that. From the absolute foundation up. By the end of this episode, you will understand what the stock market is and why it exists, how prices are actually set, what drives them in the short term and in the long term, who the major participants are and what they are trying to do, what index funds actually are and why they matter so much, and how to think about market cycles, volatility, and crashes in a way that produces rational behavior rather than panic. This is the episode one would have wanted to hear before I ever placed my first investment. Let us build it properly. Start at the absolute beginning. What is a stock? A stock is a unit of ownership in a company. When a company issues stock and sells it to the public, it is dividing itself into millions or billions of tiny ownership pieces and selling those pieces to whoever wants to buy them. Each piece is a share. Each share represents a proportional claim on the company's assets, earnings, and future value. When you buy one share of a company, you own a tiny fraction of that company. You are entitled to a proportional share of any dividends the company pays. If the company is liquidated, you are entitled to a proportional share of whatever assets remain after all debts are paid. And if the company grows and becomes more valuable over time, your share grows in value with it. Why do companies issue stock? Because growing a business requires capital. Money to hire people, build products, expand into new markets, acquire competitors, develop technology. A company can raise this capital in two ways. It can borrow it, which creates debt that must be repaid with interest regardless of how the business performs. Or it can sell ownership stakes, equity, to investors who then share in the upside if the business succeeds and bear losses alongside the company if it struggles. Most large, growing companies do both. But equity financing through the stock market is one of the most powerful capital-raising mechanisms ever invented, because it allows companies to raise enormous amounts of money without taking on the fixed repayment obligations that debt requires. The first time a company sells its stock to the public is called an initial public offering, or IPO. Before the IPO, the company is privately held, owned by its founders, employees, and private investors. After the IPO, any member of the public can buy or sell shares on the open market. The company raises money from the initial sale of shares. After that, when you buy a share of Apple or Tesla or any other public company on the stock exchange, you are not buying it from the company. You are buying it from another investor who previously owned it and is now choosing to sell. The company already received its money at the IPO. The secondary market, what most people think of as the stock market, is simply a marketplace where existing shareholders trade with each other. This distinction is more important than most people realize. The daily price movement of a stock on the secondary market does not directly affect the company's finances. Apple does not become richer or poorer because its stock price moves on any given day. What the stock price does is determine the market capitalization, the total market value of all outstanding shares, which affects the company's ability to raise additional capital, the wealth of executives and employees who hold stock, and the cost of using stock to acquire other companies. But the company's day-to-day operations run on revenue and profit, not on stock price. Now let us talk about how prices are actually set, because this is where most people's understanding of the market breaks down completely. The price of any stock at any moment is simply the price at which the most recent trade occurred between a willing buyer and a willing seller. That is all it is. It is not a calculated value. It is not an expert's assessment of what the company is worth. It is the specific price that two parties, one wanting to sell and one wanting to buy, most recently agreed upon. Prices move because the balance of buyers and sellers changes. When more people want to buy a stock than want to sell it at the current price, buyers must offer higher prices to attract sellers. The price rises. When more people want to sell than want to buy at the current price, sellers must accept lower prices to attract buyers. The price falls. Every price movement in the market, no matter how complex it appears, is ultimately the result of this simple supply and demand dynamic. But what drives the supply and demand? Why does one piece of news send a stock up 10% while another sends it down 15%? Why does a company report strong earnings and watch its stock fall? Why does the entire market sometimes move in unison regardless of individual company performance? To understand this, you need to separate the two very different forces that drive stock prices on different time horizons. In the short term, days, weeks, months, stock prices are driven primarily by sentiment, by what investors feel about the future rather than what the present fundamentals actually show, by expectations that are baked into prices before events occur, so that when the event actually happens the market moves based on whether the reality matched or diverged from expectation. This is why a company can report record profits and its stock falls. If the market expected even better profits, the good results are a disappointment relative to expectation. And it is why a company can report a loss and its stock rises. If the market expected an even larger loss, the smaller than feared result is a positive surprise. Short-term price movements are also driven by technical factors: momentum, market structure, option positioning, fund rebalancing, liquidity conditions, that have almost nothing to do with the underlying business fundamentals. Professional traders and algorithms exploit these short-term patterns. For long-term investors, these short-term movements are almost entirely noise, meaningless fluctuations around a long-term trend that is driven by something completely different. In the long term, years and decades, stock prices are driven by business fundamentals. Specifically, by the earnings power of the underlying business and how that earnings power grows over time. A company that consistently grows its revenue, expands its profit margins, generates strong free cash flow, and reinvests intelligently in future growth will, over a sufficiently long time horizon, produce a rising stock price that reflects that growing business value. The short-term sentiment fluctuations, the daily noise, the quarterly surprises, the macro fears, all wash out over long periods, leaving behind the fundamental reality of the business's financial performance. This is the single most important insight in all of long-term investing. In the short run, the market is a voting machine. It reflects what investors feel right now, which is heavily influenced by emotion, media narrative, momentum, and sentiment. In the long run, the market is a weighing machine. It reflects the actual economic weight of the underlying businesses, regardless of what sentiment said along the way. This framing comes from Benjamin Graham, Warren Buffett's mentor and the father of value investing. And it remains the clearest explanation of why long-term investing in quality businesses works despite short-term market chaos. Now let us talk about who is actually in the market, because understanding the participants changes how you think about your own position within it. The first category of participants is retail investors. Individual people, you, me, anyone with a brokerage account, buying and selling stocks based on their own research, instincts, recommendations, or automated investment plans. Retail investors collectively represent a significant portion of market volume, but individually they are the smallest and least resourced participants. The second category is institutional investors. Pension funds, insurance companies, sovereign wealth funds, university endowments. These institutions manage enormous pools of capital, often hundreds of billions of dollars, on behalf of beneficiaries or policy obligations. They tend to invest on long time horizons with conservative mandates. Their sheer size means that when they move capital between asset classes, they move markets. A pension fund deciding to increase its equity allocation by 1% can represent billions of dollars of buying pressure. The third category is active fund managers. Mutual funds, hedge funds, and other actively managed vehicles that employ professional analysts and portfolio managers to select investments with the goal of outperforming the market. These participants do enormous amounts of fundamental research, have access to management teams, sophisticated data, and analytical tools unavailable to retail investors. And despite all of this advantage, the data consistently shows that the majority of active fund managers underperform simple index funds over any 10-year period or longer. Not because they are not intelligent. Because markets are highly competitive, and the collective intelligence of all participants makes it very difficult for any individual participant to consistently identify mispricings before everyone else does. The fourth category is index funds and passive investors. This category has grown dramatically over the past 2 decades to the point where it now represents a very significant portion of total equity market ownership. Index funds do not try to select individual stocks. They simply buy every stock in a defined index, the S&P 500, the total market, a specific sector, in proportion to each stock's market capitalization. No research. No selection. No active management. Just automatic, proportional ownership of everything in the index at minimal cost. The rise of index fund investing is one of the most important developments in the history of personal finance, and we will talk about why in more depth shortly. The fifth category is algorithmic and high-frequency traders. Firms that use mathematical models and computer algorithms to execute thousands of trades per second, exploiting microscopic price inefficiencies that exist for fractions of a second. These participants provide liquidity. They are often willing to take the other side of trades that other participants want to make, but they also extract value from the market in ways that are essentially invisible to retail investors and largely irrelevant to long-term investment outcomes. Understanding this ecosystem matters because it tells you where your genuine advantages and disadvantages lie as an individual investor. You cannot outcompute the algorithms. You cannot out-research the institutional analysts with teams of professionals. But you have advantages that none of these participants have. You have no performance benchmark to meet on a quarterly basis. You have no clients to report to who will panic and withdraw capital during downturns. You have no regulatory constraints on what you can own. And most importantly, you have the ability to be patient, genuinely, indefinitely patient, in a way that no professional fund manager with quarterly performance reviews and career risk can be. That patience advantage, used intelligently in a long-term investment strategy, is worth more than any informational or computational edge. Now let us talk about market indices and index funds, because these are concepts that most people have heard but fewer people truly understand at the level that makes their financial behavior better. A market index is simply a list of companies, grouped by some criteria, with a mathematical method for calculating their collective value. The S&P 500 is an index of 500 of the largest publicly traded companies in the United States, weighted by market capitalization. The Dow Jones Industrial Average is an index of 30 large American companies. The Nasdaq Composite includes thousands of companies listed on the Nasdaq exchange, with a heavy weighting toward technology companies. These indices are used as benchmarks, reference points against which investment performance is measured. When someone says the market was up 1% today, they almost always mean one of these major indices rose by 1%. An index fund is an investment vehicle that replicates the composition of an index. A fund tracking the S&P 500 buys shares in all 500 companies in the index, in the same proportions as the index weights them. When you buy one share of an S&P 500 index fund, you are effectively buying a tiny piece of 500 of the largest American companies simultaneously. The mathematical case for index funds is one of the most robust findings in all of financial economics. Because index funds own everything in the market rather than selecting from it, they capture the total return of the market minus their fees, which for the best index funds are now essentially zero. Active managers, who must pay research costs, trading costs, and management fees, and who must be right more often than the combined intelligence of every other market participant, find it nearly impossible to consistently beat the index after all costs are accounted for over long periods. Index funds also solve a behavioral problem. Because they require no selection decisions, you simply buy the whole market and hold it. They remove most of the psychological traps we discussed in Episode 3. There is no stock to get anchored to. There is no individual position to become emotionally attached to. There is no thesis to defend or abandon. There is just the market, in aggregate, compounding over time at whatever rate the overall economy grows. For the majority of investors, particularly those without deep financial expertise, significant time to research individual companies, or genuine informational advantages in specific sectors, index funds represent the most rational, evidence-supported, cost-effective investment strategy available. Now let us talk about market cycles and crashes, because this is where most investors make their most expensive mistakes, not during calm markets but during the extremes of the cycle. Markets move in cycles. This is not a law of nature, but it is an extraordinarily consistent historical pattern, driven by the interaction of economic fundamentals with human psychology. Economies expand. Corporate earnings grow. Investor confidence rises. Stock prices rise, sometimes well ahead of fundamentals. Sentiment becomes euphoric. Valuations become stretched. Eventually something, a shock, a policy change, a reversal of some underlying trend, triggers a reassessment. Prices fall. Sentiment turns fearful. Selling accelerates. Prices overshoot on the downside. Eventually valuations reach levels that attract buyers. Confidence slowly rebuilds. The cycle begins again. The duration and magnitude of each cycle varies. Some bull markets last a few years. Some, like the one that ran through most of the 2010s, last over a decade. Some bear markets are sharp and brief. The COVID crash of early 2020 lasted just 33 days before the recovery began. Others, like the aftermath of the dot-com bubble, grind lower for 2.5 years. What remains remarkably consistent across every market cycle in history is this. Investors who stay invested through the entire cycle, who do not sell during the crash and who automatically participate in the recovery, produce dramatically better long-term outcomes than investors who sell during the downturn and attempt to time their re-entry. The mathematics of missing the market's best days is sobering. Studies consistently show that the majority of the stock market's total long-term return is concentrated in a small number of extraordinarily good days, days that almost always occur close to the bottom of severe market downturns when sentiment is at its most fearful. An investor who was out of the market during just the 10 best days of the last 20 years would have seen their returns cut by more than half compared to someone who was simply invested throughout. An investor who missed the 20 best days would have produced returns worse than holding cash. The reason this matters is that the investors most likely to miss the best days are the ones who sold during the worst days, the crashes, and who sat in cash waiting for clarity before re-entering. By the time clarity arrives, the best days have already happened. The recovery is already underway. The investor re-enters at higher prices and has permanently impaired their long-term returns. This is not an argument for recklessness or for ignoring genuine risks. It is an argument for understanding that market crashes are a normal, recurring feature of investing, not catastrophes to be escaped but temporary repricing events to be endured and, ideally, exploited by adding to positions at lower prices. Let me close this episode with the most important mental model I know for thinking about the stock market in a way that produces consistently better behavior over long periods of time. Think of the stock market not as a scoreboard that tells you how your investments are performing at any given moment, but as a store that is occasionally, and temporarily, having a very large sale. When the market falls 20 or 30%, it is not signaling that the underlying businesses have permanently lost that much value. In most cases, it is signaling that investor sentiment has shifted, that fear has temporarily displaced greed, and that prices are available at a discount to the long-term fundamental value of the underlying businesses. If your favorite store held a 30% off sale on everything, you would not feel afraid and rush to sell everything you previously bought there at full price. You would buy more. The market sale is the same rational opportunity, but human psychology responds to falling prices in financial markets with fear rather than the excitement that falling prices everywhere else produces. Building the mental habit of seeing market downturns as sales, as temporary opportunities to acquire ownership in great businesses at reduced prices, is one of the most valuable and most difficult cognitive reframings in all of investing. It requires the emotional discipline to feel fear and act opposite to it. It requires genuine conviction in the long-term trajectory of the economy and the businesses within it. And it requires the financial architecture, emergency fund, no over-leveraged positions, no short-term need for the invested capital that makes staying invested through a downturn practically possible. But for investors who have built that architecture and that conviction, the market's periodic sales are not threats. They are the mechanism through which patient, long-term investors accumulate the extra return that distinguishes exceptional long-term outcomes from merely average ones. The market is not your enemy. It is not a casino. It is not a mystery. It is a mechanism for allocating capital to productive businesses, imperfectly in the short term and remarkably efficiently in the long term, governed by the collective behavior of millions of participants whose short-term irrationality creates the long-term opportunities that patient, informed investors have exploited for over a century. Now you understand it. Use that understanding well. This is SERA Finance. Episode 11 is done. Season 2 is open. Episode 12 is coming, and we are going deep into real estate, the asset class that has created more millionaires than any other in history, the specific mechanics that make it so powerful, and the honest framework for deciding whether it belongs in your financial life and at what stage. Subscribe. Turn on notifications. Be here. Smart money. Real talk.